Sometimes the lies perpetuated by the mainstream business media are so egregious that it would require a near impossible suspension of disbelief to accept were it not for the simple fact that such lies are documented and often exposed to the light of truth. The latest example of financial deception comes from Forbes, where contributor Brian Rich wrote an article entitled 4 Simple Reasons an Epic Rally is Ahead for Stocks. His lead-in argument is claimed to be historical in nature, where he applies a linear regression formula of 8%, which happens to roughly equate to long-term annualized returns of US blue chip indices against the absolute high of the S&P 500 index in 2007, and forward calculates a forecast for 2016. According to his model, we should see an S&P 500 of 3,150 points by the end of next year. We of course have a couple of profoundly elementary and thus critical problems. In finance, conservatism is both the written and unwritten law of generally accepted accounting principles. It is entirely unethical and unprofessional to apply best-case scenarios to any financial analysis or forecast. The one exception is afforded to buy-side Wall Street analysts because the nature of their job dictates that they be snake oil salesmen. Otherwise, most people, and especially so for the media, should always err on the side of conservatism. Such principles should have been taught at a very early point in one's finance career, and it is extremely surprising that Forbes would risk sullying their reputation on such oversight. The second problem is the insinuation of Mr. Rich's analysis. Since his message is rather opaque, readers are left to logically conclude that the markets are undervalued relative to the value that the markets would have accrued if it consistently gained 8% annually. This efficient market hypothesis works well only on paper. Financial systems are constantly acquiring news that would affect trading psychology, and the very existence of boom-bust cycles contradicts any notion of market efficiency. But there is an even deeper problem with this logical insinuation that points towards a critical lack of numerical literacy on Wall Street. The concept of average annualized returns is extremely deceptive in finance because the calculation is a topical and sequential aggregate of a year's worth of trading data. They are historical statistics and bear little to no probability value unless there is some sort of contextual and structural consistency in the formulation. If a poker player has won 60 out of 100 games, he has a base probability of being a winner 60% of the time. However, this historical information alone does not mean that the next game he plays that he will have a 60% chance of winning. Mr. Rich, or more accurately his source, billionairesportfolio.com, makes the unfortunate mistake of forecasting 2016's price point simply on the basis of historical averages. It's impossible to use long-term data to calculate a short-term probability unless highly advanced modulations are incorporated. At the very least, sequential binomial calculations would need to be deployed to address even a portion of contextual and structural factors. Applying a simple linear regression against statistical averages for forecasting purposes is as useful as trying to shoot a target at 600 yards without adjusting for windage and elevation. In both cases, you'll likely expend a lot of time and energy being wrong.